Strike. Let's bring in Jeff DeGraaf from Renaissance Macro Research on the charts. And Jeff, want to get to you on the broader market, S&P 500 going into a Fed rate hike, because that is really the underpinning and what some of this tech selling is all about. Just remind us what happens, what the charts show about where the market goes as the Fed starts hiking rates.
Yeah, well, thanks for having me first, Sarah. Thank you so much. Happy New Year. And, what I'd say is when we go back and look at the markets back to the early 1960s, so we have a lot of various cycles, particularly monetary cycles. You'll see there from that first chart that, it's really not the end of the world when you have the first rate hike. In fact, the market does pretty well going into that first rate hike. And I think really a lot of that has to do with historically the Fed is behind the curve. They wait, sit on their hands and make sure that the recovery is self-sustaining historically. And so that tends to be good news for the overall market. It does shift, though, some of the factors and some of the sectors. Some do better than others. And, one that we've been focusing on and really trying to position clients towards is more high quality and away from beta. I think that's going to be very important for 2022.
Jeff, what about tech in particular? How vulnerable?
Tech is what we consider, what we called and we've coined concept finance, right? It's these names that are at the fringe. They're better story names than they are underlying fundamentals. They're sort of requiring this excessive liquidity to do well, to raise capital once, twice, three times in additional offerings. I think it's best represented by things like the IPO index and the SPAC index. And unfortunately, a lot of those names are also tech names. A lot of software names came out. Obviously, there's some crypto in there as well. And it's a smattering. There's some payment names and the like. But when we look at tech, again, going back to 1964, in the face of the first rate hike, it actually doesn't do very well. It's one of the relative laggards. But interestingly enough, after the first rate hike, it actually starts to find its feet and do a little bit better. So I think we've got some tough sledding. If we presume that the Fed's not going to raise rates until March, we probably have a tough first quarter, but it should line up and start to find some support as we get into the second half of 2022.
And you've got another chart for us as well relating to the Fed and the broader markets.
Yeah, look, I think the Fed is in a really difficult position here. They're tapering and they plan on raising rates. And if you remember from Chemistry 101, what you really want to do is isolate one variable at a time and see what the impact of that one variable is on the end result. And so as the Fed's sort of double dipping here, trying to pull two levers that I don't think they really understand exactly what the impact might be on the economy, I think there's the risk of a policy mistake. And one of the things that we look at is where where the yield curve is today, which is roughly 100 basis points, let's call it, in terms of steepness between 2s and 10s. Historically, that's at least 190 basis points before the Fed starts raising rates. So they're already starting up looking at taking back this liquidity in a relatively flat curve. And the good news has been over the last 2 or 3 days, we've obviously seen yields pop, which is great because we want to see that curve steepen. But if we see a flattening curve as the Fed continues to withdraw liquidity, that to us is going to be a sign that there's a potential policy mistake in the making. And that would be bad news for equities for 2022.
In other words, that they were too late and that the economy is already in a downturn?
Yeah, that they're too aggressive, that the back end's not supporting a strong economy and that they're actually taking away the stimulus a little too prematurely. So that'll be important to watch as we go forward. And frankly, I would have expected the second half of 2022 would have had a steeper yield curve. Now we had Omicron and some other things that have had an impact. And you pointed out China earlier. I think that's absolutely spot on. But it will be important to see this continuation of the steepening of the curve, and that will support things like financials, and it will support things like some of the cyclicals versus defensive names, and that will be important for this story of 2022 to continue.
Which sector looks most vulnerable?
Well, I would say tech is from the highest flying to the transition. That one looks vulnerable to us. But I also say that some of the discretionary names still look vulnerable to us as we get this shift. And it's not discretionary is a very diverse area. It's things like leisure products, gaming, some of the internet retail names. Those look more vulnerable. Housing still looks good. So I think that's good news for the underlying economy and a subsector of discretionary that looks good. But tech and discretionary are two that we're watching very carefully as we've seen some deterioration there that looks more than just corrective. It looks like it's potentially end of cycle for those names.